So, about 23.8 million of us South Africans are currently using debt in some form or another. So, I would think it's quite essential for us to be familiar with some debt lingo and how it affects us. So in today's video, I will be breaking down the most common debt terminologies to help you make better choices before taking on any debt. And this is the third video in the debt management series. So the main concepts I want to cover in this video is credit scores and debt to income ratios. But before we get into that, let's cover the basics. The first concept when it comes to the basics is good versus bad debt. So how do you know if your debt is good or bad? Well, good debt is debt that is used to buy appreciating assets. And appreciating assets are assets that increase in value or assets that actually generate an income. An example of an appreciating asset is a house. And then an example of an income generating asset is a car. If you put it into Uber and you're actually making more money than what the loan is costing you on a monthly basis. Now let's talk about bad debt. Bad debt is debt that is used to acquire consumables or depreciating assets. Basically things that you just can't afford to pay cash for, but they won't generate any money for you. An example of this is debt acquired to buy clothes or things like food. And a car can also be a bad debt if you're not using it to generate income. The next concept is secured versus unsecured debt. Secured debt is debt that is associated with an asset. And typically, debt that is associated with an asset comes with a lower interest rate because the bank can usually come and take the asset in the case that you don't pay. That would be things like cars and houses. And unsecured debt, on the other hand, is a debt that is not associated with an asset. So these ones typically have a higher interest rate because there's nothing that the bank can come and claim in the event that you don't pay. So it's a higher risk for the bank to give you the money. And these would be things like personal loans and credit cards. The next concept is hard versus soft inquiries. A hard inquiry happens when a financial institution reviews your credit report because you've applied for a loan, a credit card, or a bond. And this typically affects your credit score and stays on your credit report for about 12 to 24 months. This is actually something that affected me a few months ago when I applied to switch my home loan to a different bank to try to get a better interest rate. So I ended up losing 5 points on my credit score because of that, because the banks were actually looking at my credit report to determine whether I deserved the lower interest rate or not. A soft inquiry is when your credit report is reviewed, but for reasons that are not linked to a debt application. This would include things like background checks and also car insurance codes. Now, this one doesn't appear on your credit report, and it also doesn't affect your credit score. Let's get into the more serious concepts. And the first one is interest rate. So interest rate is the cost of borrowing money. So this is how much the bank is charging you for buying something on your behalf. So you've seen a car that you like and it's going to cost about 500,000 and you don't have 500,000. So the bank will buy the car for you. They will pay for the car and then you need to pay them back the money that they gave you, which is what is called the principal balance or the capital balance. And over and above that, you need to pay for the fact that they gave you the money. And that's what interest is. This number is a percentage and it's usually determined by the type of loan that you're getting, and it's also determined by the prime lending rate and your credit score. Now, what is prime lending rate? This is the baseline that banks use to price their products. This number is currently sitting at 10.5%, and the number is always the repo rate plus 3.5%. And the repo rate is the percentage that the Reserve Bank, which is our central bank, charges commercial banks to lend them money. So the interest rate fluctuates based on what's happening in the economy, which is why we get nervous when we see this guy. The reason you need to know what the prime lending rate is so that you know whether you're getting a good deal or a bad deal when you apply for debt. Let's explore what a good or bad deal looks like for a home loan, for a car loan, and for a credit card. The rule of thumb when it comes to interest rates is that the closer you are to prime, the better. But the further you are from prime, the worse off you are. Unless you're under prime, where the opposite would apply. When it comes to home loans, good looks like prime going downwards. Anything less than 10.5% is what would be good. And maybe up to prime plus 2%. But the minute you start going higher than that, you have a bad deal. Now for vehicle finance, prime up to prime plus 1.5% is good. But if you have something like prime plus 5% and above, that is really bad. For credit cards, if you're between 14 to 17%, that's still good. But if you are 20 something percent, that's really bad. Now that we know what good or bad interest rates are, let's see what actually influences what rate you're going to get, which is the credit score. A credit score is a number that tells lenders how responsibly you manage your debt and how likely you are to pay your debt on time. So it's a measure of trust. If you have a good credit score, you're likely to get debt for lower interest rates. If you have a bad credit score, you're likely to get debt for higher interest rates. So your debt will be more expensive. This is why two people can walk into a dealership and walk out with the same car and pay two completely different installments. If you have a good credit score, the bank knows that they are likely to get their money back, so they don't need to charge you exorbitant rates. But if the bank can't trust you because your credit score is bad, they need to get back as much of their money as quickly as possible in case you stop paying. So the score that you have and whether it's good or not will depend on which credit bureau you're using, because the different credit bureaus are actually using different scoring systems. I'm going to put up a summary for the two biggest ones, which are Experian and TransUnion. But my rule of thumb is if it's 600 or less, it's bad. A lot of people go and acquire debt with the aim that they want to improve their credit score, but then they end up ruining it. So if you are not intending to acquire any debt anytime soon, such as maybe a new car or a home, then don't worry about your credit score and building it up for now. Because your credit score only matters if you intend to borrow. But if a house is not in the cards for you, if buying a car on credit is not in the cards for you, then what is the point? Because what are you building it up for? Now let's look into what actually goes into your credit score. First, it's your payment history, whether you pay on time or not. Then it's your credit utilization. This is the amount of credit you used as compared to your limit. For example, if you have a 10,000 Rand credit card, if you're using all of it, it's bad. If you're using about 30%, you're in the sweet spot. The next is the age and history of your account. So the debts that you have, how long have you had them and how long have you successfully managed them? Then types of credit. This is just a diversity and mix in the types of debts that you have. And then lastly, inquiries as well. Whether you've applied for credit recently. Those hard inquiries that I was talking about. Now let's talk about debt to income ratio. Now this one is a measure of whether you can afford debt. You might be good at paying off debt, but can you afford more debt? This is the ratio between your gross monthly income and the amount that goes towards paying off debts. And you can calculate it by taking your total monthly debt payments divided by your gross monthly income times 100. What's a good DTI or debt to income ratio? If you're under 36%, then you're in a good financial position and you will likely get accepted for new debt and lenders will view you as a low risk borrower. But if you are between 36% and 43%, yours is still acceptable but not quite ideal. And if you're over 43%, then you are a risky borrower and banks will likely decline your request. At this point, you might actually even be over indebted if you're higher than this. I hope that was somewhat educational and you took a thing or two that you can apply to your situation.